2023 for me is offering great volatility. So I think we've all gotten used to this kind of wild market. I think it's going to be more of the same, maybe even more volatile. I do think at one point the S&P finds itself well down over 30% from the all-time highs in 2023. And I do think that gold is one of the places to hide. In general, I would agree with that. I think that 2023 for me is offering great volatility. So I think we've all gotten used to this kind of wild market. I think it's going to be more of the same, maybe even more volatile. I do think at one point the S&P finds itself well down over 30% from the all-time highs in 2023. And I do think that gold is one of the places to hide. As the Fed kind of gets to that point where they say, okay, we're going to start to that, reduce the amount of hikes we're doing. We're going to go to 50 basis points, then 25, then maybe zero. That's all gravy for gold, right? Gold wants a Fed that is either zero hikes or dropping rates. And I think what you'll see is an economy that still has decent inflation, which is going to keep the pressure on gold to the upside. But the Fed won't be able to hike much more because the economy is going to slip into recession. So I'm right there with that, actually. The beauty of it is that, in all fairness, gold it wasn't like it was up 50% for 2022. But the crazy thing about gold is that if you compare it to the S&P or to Bitcoin, that was the place to be in 2022, right? So it's done really well. What I love is the recent price action. And what I want to show you guys is take a look at this. So you had this little W bottom pattern. You had a breakout, a retrace to that level, and then it went up to the next level of resistance. You can see this top here and this area right back here. Now, my guess is that you'll actually see another breakout to the upside here, and eventually we're going to find ourselves back to this kind of triple top. It'll be a triple top at that point in 2023. Now, I actually do think we'll exceed this level. The question is by how much, but I do think that we will exceed the 2070 high on gold in 2023. So look at a certain, like a target line. I would say you could connect this high here. And so you could be looking at least 2150, maybe 2200 on the upside as resistance in 2023. So percentage wise, that's not bad. I mean, you get to 2150-ish, you're looking at about 20% or so upside in gold for a year, which for gold, that's an awesome, awesome year. Now, one of the interesting things about the miners and why they generally were weaker in 2022 is because inflation pressures really ate into their ability to generate profits. And I think people don't understand that. When gold, even if gold just stays at flat, because they had to pay their labor more, their costs for their equipment went up because of inflation, they were really getting squeezed in terms of their profitability. Now, if you get inflation to kind of stall out and maybe not go up anymore, this is where a rising price in gold can really help them do well. To answer your second question, you went into, where's the place to be? So I think gold miners, that's where you want to see your money in 2023. And then I also think you want to be somewhat of a swing trader. You don't want to be a long-term investor yet because I think the economy will go into recession. But I think there are stocks out there that they'll get so discounted, good quality names, that you can play them for bounces over the course of the year. I also think that we'll likely hit bottom on Bitcoin in 2023 as well. And that will offer a very interesting kind of risk reward trade. So I'm looking actually on Bitcoin like around 9,000. I think we head down there, but I think once it gets there, it becomes very, very intriguing as a long play. Yeah. So, originally I was talking about just sub 20,000, that 18,000 level. And then what really ended up happening here is that, the more I studied cycle action and cycles, it's not so much the FTX scenario. It's more just the inability for us to even see any sort of rally. It's just step down, step down. And what you have to do is you have to look and realize that the Fed is no longer printing of money. And so this is the first bear market in Bitcoin where the Fed hasn't been printing money, which means it probably needs to do even more downside than past cycles. Past cycles were 80 to 85% decline. We haven't even quite achieved that yet. So I think on a stopping point, that 18 to 20 was the first stop. I think there'll be another bounce around 12 to 13. But I think you have to look at the 9,000. You want to get to max pain on Bitcoin, just like any cycle. It has to get to max pain. And that probably is when it breaks 10,000. You'll finally get some sort of bottom there. Yeah, so I do think that it'll get down to like close to 10, and then you'll have that sharp dip below 10, which will wipe out a lot of stops. There'll be a lot of stops in that vicinity. And I think that'll come with either a shock on regulation, right? The announcement of regulation, which I actually view to be a very, very positive thing for crypto. But I think initially it's going to shock most crypto investors. They're going to say, oh my gosh, these cryptocurrencies have to do X, Y, and Z now. Oh my goodness, can they afford to do that, right? Whether it's audits or this or that. And I think that's going to initially panic, and then you'll see big money come in and scoop that up. So I would say it's most likely regulation. I think to me, FTX is like a Lehman Brothers moment in '08. And what's interesting about Lehman Brothers is the S&P from that date fell for another 5 to 6 months. It fell about 40 to 45%. And so if you think about FTX being the Lehman Brothers of the crypto market, it then means that we probably bottom out by Mayish, maybe June. And we probably, again, 40 to 45% drop from there takes us to about 9,000. Yeah, there's no doubt that anytime you get these bad actors in a sector like crypto, that's going to be the reasoning behind. They're going to give that reasoning. Hey, we have to do this because if not, then people are going to get their money stolen and so forth. Having said that, I think the digital central bank currencies, the risk that they're going to push on the crypto market is for stable coins, right? So if we think about it like Bitcoin, one of the alluring things about Bitcoin is that it can't be printed, right? It's mined, but there's a maximum of 21 million. A CBDC, the government can just print unlimited amounts. So you don't have that same sort of scarcity aspect to it. It's really like the dollar. It's just a quicker way to make transactions versus the dollar. So I think the big question, and I don't know the answer to this, is how does it affect things like Tether? That would be the bigger question that I would have. And I'm not 100% sure. I think, again, investing in Bitcoin, generally pretty safe. Ethereum, I think, there's so much built on the Ethereum network that I think there's a major amount of value there. But again, with the Tethers of the world and such, it's a bigger question mark with the CBDCs. And if we continue to sell off into the Federal Reserve meeting next week, I think you might actually get an end of year rally, and that could push the VIX maybe down to like 17 or so, down in this lower range. And then that's where I'm looking. So I'm trying to thread the needle on that because the VIX is so volatile. I mean, we know how quickly it can swing back and forth, but I am absolutely looking to inch into the VIX. I just need it below 20 towards that 18, 17, 16 range at that point.
Are there any good energy trades that you're eyeing up?
Wow, that's a good question. So I've been a bear on energy all year long. Again, to me, it was a no-brainer that oil was not going to go to 200 like everyone was saying. And the reasoning behind that was it was very macro and very simple to me. When we saw Russia invade Ukraine, everyone said, oh my goodness, oil's going to go to 200 or at least 150. I looked at it and I said, wait a minute. So this is going to put stress on the overall economy. Then you have the Federal Reserves around the globe hiking rates, which is going to slow the economy. Yes, the reduction in oil from Russia maybe puts a little upward pressure or cuts from OPEC, but it is dwarfed by the reduced demand for oil, right? I mean, just think about, you have a global economy which potentially could go into a global recession. We know China's basically there at this point because of their COVID zero policy. And so to me, it was like, okay, well, oil's going to go down. And sure enough, it has. Now, what's interesting about oil here is it's breaking support right here. But I do have a very key level right here. And if we zoom out, look at this going back to 2019, where you have these pivot tops and then you kind of bounce off of it here and here. And so if we do hit 65 and a half, I do at least think you get a bounce there.